Hello, everyone. My guest today is Sean Rigseiker. He is the CEO and founder of a company called Centro. He founded the company in 2001, intent on developing the most comprehensive, automated, and intelligent software platform for the digital media industry. His leadership commitment to innovation and modernized approach to culture and employee happiness has led Centro to receive many accolades. He's also a member of the Young Presidents Organization and a founding director and co-chairman of Unite America. Sean, you ready to take us to the top?
Let's do it.
All right. So what's Centro doing and what's your revenue model? Are you pure play SaaS?
We actually have both. I get the question a lot. Investors always ask me, what are we? Are we services? Are we software? And my message is always, look, we try to meet customers where they are. And as much as we'd love to sell 100% software, there's a lot of customers out there who still need help, services, training, education, support. So today, our business is around 50% where we do services for our customers, and around 50% where they do it all through our software.
Yeah. Let me ask you a quick question. This is going to be hyper specific. Then we'll go back to a macro level. If you split out the cohort of customers you've put professional services on, and you look at their churn data and expansion data, so gross annual churn, net revenue retention, things like that, do you see that they grossly overperform? They expand and stick at way higher rates than those that you use no professional services on?
Wait, so you're ask that real quickly. So you're saying do the services churn faster than the self-serve softwares?
Well, here's what I'm actually saying. I also believe that services can be an important factor in a SaaS company, especially to drive retention of customers. It's essentially an onboarding fee. So my question to you is, have you split out your cohorts, those that have paid for services and onboarding versus those that have not? And do the ones that have paid for services and onboarding have a higher stick rate?
Oh, we actually, at this point, we're not charging onboarding and training for services. That's actually something that comes along with the contracts that we sell. So people aren't necessarily paying for it. What we do find, though, is that...
Well, wait, what's your service business? What's the 50% services?
So it's digital marketing services. So there's a lot of brands and a lot of clients who say, look, I don't want to bring the platform in-house. I want you guys to actually do the work for me. And so it's more like an outsourced digital marketing services business.
You don't require that they pay the SaaS fee as well if you do the custom professional services?
Yeah. No, there's actually a SaaS fee, then there's a service fee on top of the software fee. So in other words, we go out and we sell software, okay? And then the software is you can use it all on your own. But if you need us to actually work and help inside your own instance, then we'll add a service level on top of that. And that's helping them. It's kind of like a training wheel. So, going from I need help to I got some team who can do it, to I'm fully self-serve. So we really take people through the continuum across the board.
That's what I'm asking. The ones that you run it for them, they pay for the software instance, but then you run it. Is the churn rate higher or lower on that cohort?
The services is lower or is a higher churn rate than the actual embedded software. And I would say the reason for that in our business is that if we're just doing services for someone, they can easily theoretically go and find another services provider. But if they have our software installed, and you got to remember, our software is slightly different than ad tech software, where it's your system of record, it's your financials, it's your workflow automation, it's all of your client brand, supply chain management. So everything's inside of it. Once you install the software, it's very, very difficult to actually rip that out because your finances are running on top of it.
Mm-hmm. Are we talking enterprise play here on average? What's the customer paying you just purely SaaS per month or per year to use your technology?
Yeah, so because we work in the marketing business and there's a trading aspect to the platform, so real-time bidding, programmatic advertising, it's actually a blend. So we charge on a per seat license basis, but then we also actually have a variable pricing based upon margin, based upon what runs through the trading and real-time bidding platform.
Yeah, I imagine though that revenue is, both those streams you just said are very predictable. You can look at one customer and predict them over time.
Yeah, absolutely. I mean, there's a lot of seasonality, specifically in advertising and marketing, depending upon the quarter, depending upon what's going on with brands, where it's not like a Salesforce where theoretically it's always on, everybody's using it in equal parts. So for us, Q4 is obviously the largest quarter for us every single year because it's just the way the ad market works. But we have the ability through just a ton of analysis. We understand seasonality. We understand the ramp time. We understand how long it takes to get people to hit where their minimums are. So there's a lot of work that goes into it, but it's fairly predictable.
So when you add, Sean, that use the flat SaaS fee plus then the usage-based variable fee on top of it, on average, what's a customer going to pay you per year for the tech?
Right now, it's averaging somewhere in the $200,000 to $250,000.
Okay, so you're very much an enterprise playbook then.
Yeah,
Yeah.
absolutely.
So with that in mind, let's go to your team for a second. What's your team size today? How many people?
Just shy of 700. We'll probably hit 700 next month.
Okay, 700. And what portion of those folks are, quota carrying, commission, comp kind of sales folks?
Yeah, if you look at a pie chart of the business, easiest way to think about it is we've got around 150 in R&D, development. There's approximately 125 folks in sales. The services team, just for the marketing services, around 200. Then we've got a customer software support team, which is around 50 folks. And then you probably throw 100, 150 in the various, G&A, whether it's marketing or accounting, finance, HR, things like that.
Yeah, that's great. Now you mentioned investors and kind of telling them the services versus SaaS storyline. So how much have you raised to date?
52.5 million.
Okay, 52 and a half. Now, why did you need to raise that money to grow the company? In other words, could you have done this a little bit slower, but kept all your equity with no raise?
The funny thing is, I didn't raise capital for 9 years. Well, I should say that. Let me rephrase it. I raised $2 million after I bootstrapped it for 5 years. I raised $2 million. Then 5 years went by, and that's when I raised our Series A, which was $22.5 million. And then 3 years went by, and that's when we raised $30 million. So, I mean, if you add in the angel, it's actually like $55 million that we raised in total. So, but if you look at it from this perspective, half of all of that money went out for acquisitions. So we haven't really needed a lot comparatively to our competition to actually build a company. I've always said there are two muscles that you can, build in the company. You can figure out a way to be great at raising capital, or you can figure out a way to, create revenue and service customers. And I've always, taken the slower road and said, let's actually, be great at servicing. Let's be great at creating revenue, and let's build it intelligently. And because of that, if you add up all of the investors, it's still a very minority stake inside of the overall cap table.
Would you say less than 30% total?
It's actually about right on 30%.
Oh, so I expected it was something around there. Do you have co-founders or just you?
Just me.
That's great. Now, you just gave a great timeline, but I forgot to ask you the start date. Was it 2001?
Yeah, late at the end of 2001.
Okay. Okay. Interesting. And then, so talking about funding, you said a lot of this was for actually M&A, right? So let me go into one of these for a second. So Site Scout, was that a pure play SaaS company or was it services as well?
Pure play. They didn't have a salesperson in the entire company.
So it was SaaS.
100%.
So that was a $40 million acquisition price there. Did you, there's a lot of companies today, especially private equity firms, but even bigger companies that are doing roll-ups, hub and spoke models, where they'll go buy a company like Site Scout and the price will be $40 million. But actually what they'll do is they'll go hook up with an SVB or CIBC or a debt provider, and their equity exposure will only be like 5 to 10%. Did you use any kind of debt in these deals, or did you just raise capital right off your balance sheet and then just pay that in?
So we actually set up the deal where it was cash up front. There was a 2-year earnout based upon performance. They got paid 100% of what that looked like. And then the remaining value of it came in Centro equity.
Okay, good. So you limited cash.
Yeah, we didn't bring on debt for that one.
Yeah. Okay, good. Have you used it in any other acquisitions or no?
We have not used the first acquisition we did in 2008. You got to remember, 2008 was a really weird time.
This was Real Cities?
Yeah, this was Real Cities. And the way we structured that, it was, not to get too deep into it, Knight Ridder had pretty much gone bankrupt. McClatchy had purchased the assets from Knight Ridder. Real Cities came along with that. It wasn't an asset that they wanted to take over or invest in. And so what we did is we worked out a deal, because I didn't have any money at the time. I hadn't raised my own capital. So that was actually a seller financed note in which we put a price tag on it. It's about $10 million, and we paid them as a percentage of our net revenue, and we ended up paying it off over I think 3 years or something like that.
Well, and what was the percentage?
So long ago, I don't even remember.
That's okay, but you basically paid it off before 2012? Yeah, that's that's interesting. Okay, very good. And
there's so many creative ways to structure things these days.
That's why I ask.
You have to be creative inside of them. You got everything. You've got equity, you got seller finance, you've got debt. I mean, there's so many different ways you can take it.
Yeah, but you have strategically chosen to do other things besides debt, which tells me you feel like you've got leverage doing other things instead of just taking a 7% kind of debt line and doing these things. I'm trying to get a better sense of why you feel that way.
I just think it's also depending upon your profile. We've never been trying to run the company to maximize profit. In order to actually bring on significant amounts of debt, you're going to have a higher profit profile than what we've chosen to. I mean, we've been continually trying to invest in growth every single year. And so there's also just a level of working capital you need in our business because we run approximately, call it $60 million a year through the company that we only get to keep a margin on. And so
just to be clear, Sean, that's the ad spend through your platform, the GMV.
Right. Yeah. Yeah, that's right. And then if you take a look at, Google and Facebook, theoretically, they want to get paid in 30 days. Okay. Well, your client doesn't pay you for 80 days or 90 days. And so, we have to, we've got a huge float, that we've got to really manage. Really
negative.
Well.
It's actually negative float, right? It's a reverse float.
A negative float. Yeah. And so that's why we need, so a lot of, and then, we have to have debt in order to create the working capital line. And so we've got that. But that, on the other hand, limits our ability to theoretically take on even greater debt to actually do acquisitions or whatever we'd want to do with it.
How cheap have you been able to get that working line at? Are we talking like 6-7%, or is it more expensive?
No, I think it's actually below that, but it's probably right around 6 at this point.
Okay, that's pretty good. Okay, very good. And then 2001 was launched. Obviously, you've grown via M&A. You raised some capital, doing it obviously in intelligent ways. How many customers are you serving now today?
It's about 1,700 on a yearly basis.
Okay, 1,700. And true or false, all of those pay the software fee, and a 50% of them also pay you to run the instance of the software they purchase from you?
Yeah, directionally, that's true.
Okay, got it. Something here is wrong with my math, unless you're a $1 billion company that I didn't know about. If I take 1,700 customers times that average ACV you told me earlier of $250,000, that would put you at $34 million a month right now in revenue. Obviously, that's too high. What's wrong?
I'm sorry. That was actually gross media spend running through the platform. And then we get a cut on something and so we get a cut on that. So if you look at here, if you do the numbers, our margin collectively, is right around 15 to 20%, based on the total gross dollars that run through the actual total, that run through the whole company, including services and software. And if you do the math at, call it $700 million that'll run through the platform, you'll actually get to what our revenue is.
About 90 million.
It'll be closer to 150.
Okay, good. So 15. Well, I was only taking of the spend.
700 was last year, and I think we're probably on track to around 800 to 850, maybe $900 million this year through the platform.
Yeah. I was going to say 700 through the platform, obviously, and taking 15% of that, you'd be at about 105 in terms of run rate. Now, is that your entire business, or is the SaaS model included all on top of that?
No, that's the entire business.
Yeah, that's what I thought. Okay, and then this year 140.
Correct. It's a blended margin. Yes, that's exactly right.
Yeah, very cool. All right, very good. And then what are you spending to get a new customer? Fully weighted CAC. How aggressive are you being?
I don't have that data in front of me. Sorry.
Do you know? Hypothetically, as a CEO running a fast growing company, would you spend first year to get them up front, or no? Is that too much?
It's not something, just because of our model, the way we look at it, it's not something on a CAC basis we track specifically, because it's not necessarily marketing driven. Here's what we spend. There's if you got to look at it, whatever we pay our salesperson, we expect that salesperson to bring in 4X, whatever their compensation is.
Full OTE?
Yeah. So it's around 22% and we're a very sales-driven culture. I mean, almost all of our clients come from the sales team, not marketing. And so from that perspective, if you take a look at the numbers, about 22% of our revenue goes out in the form of sales expense.
Okay, yeah, that makes sense. But just to be clear, if a salesperson's on target earnings, meaning they get their full commission, comes out to essentially $100,000, you're saying their quota would be at minimum 4X that in terms of new business, so $400,000.
Correct.
Yeah, that's actually not as aggressive.
That's actually what they will do over the course of a year. And they've got a lot of customers who they still get paid on that they signed up, say, 2 years ago. So it's not necessarily it's not necessarily new business per se. But if you look at, a seller, making 150, 200, we expect them to bring in anywhere from 800,000 to about $1 million in revenue on an annualized basis.
Yeah, that's actually, Sean, that's way less aggressive than most CEOs in the kind of $100 to $200 million run rate range I'm at. They're usually optimizing for like 7 to 10x. I wonder if that's a function of your revenue split or something.
I think it has more to do a function of one, probably the revenue split, but frankly, it's also a matter of just the growth and the ramp of that. Because if you look at a seller who's been here for, let's call it 5 years, they're much closer to 10 to 15 times revenue book that they're carrying. But if we look at the new sellers, what's going to happen the first year, what's going to happen year 2, year 3.
The year 1 pro forma on a new sales hire.
Yeah, the year 1 pro forma, they're going to bring in approximately 2x what they make from a compensation perspective.
And then you hope over what period of time they get up to 15x?
Usually they hit that in about 4 years.
Okay, I mean that's pretty good actually. Very good. Let's wrap up here with. Well, actually, wait, hold on, real quick before we wrap up. Burn. Are you burning today? Or are you cash flow positive?
Cash flow positive.
Oh, you are. That's wonderful. So any plans to raise in the future? Fund another acquisition or no?
Yeah, I think you're going to see us do something fairly substantial.
And is substantial more or less than $100 million acquisition?
Well, it won't be an acquisition. It'll be an actual capital raise.
Okay, interesting.
I would expect that given our profile, given our ability to go international, given just where we're at from the new software, that you'll see us do a fairly large, call that over $100 million.
Why do that instead of IPO?
There's 2 reasons. Number one, I personally, as well as other team members, haven't taken much liquidity out of the company over the years. And what
this is a secondary.
You wouldn't want to do, you wouldn't want to become a public company and then have the CEO obviously unloading shares. And so it makes a lot of sense to create some level of liquidity, both for previous investors as well as for employees.
Yeah. So just to be clear, let's say you end up doing something like a KKR or something. It's a secondary with a private equity firm. Most of that cash going towards what you just said, liquidity for early employees, early founders, et cetera. Well, you think the majority of that round will be secondary, or will any of it go to operations?
No, I would actually say, look, I mean, we haven't kicked off the entire process yet, but if at a high level, you would look at it where you'd say probably close to 50% would be in secondary. You would take a look and say probably 30% is going to go towards M&A. And then you would say probably about 15, maybe 20% is just sits in the coffers for working capital.
It's a nice place for capital to sit, right?
Yeah.
All right, let's wrap up here with the famous 5. Number 1, what's your favorite business book?
Losing My Virginity, Richard Branson.
Number 2, is there a CEO you're following or studying?
Nobody at this very second, although where do I normally go? I'm sorry,
That's okay. By the way, do you interface with Bill Walsh at all, Mediaocean?
Bill Wise.
Sorry, that's what I meant. Do you interface with him at all?
Oh yeah, I love Bill.
So he just came on the show. And I've interviewed most of the Vista CEOs because they all. This is an assumption. I have no insider information, but when Vista closes $14 billion fund, all those CEOs are getting calls from Brian and Robert going, "Hey guys, go find acquisitions. We got to deploy this capital in an intelligent way." Are you in any acquisition talks with Mediaocean or Vista?
No. If anything, we're good friends, and I think if we do something, it'll kick off more as a partnership.
I think you and Bill would be great together.
I love Bill. It's really funny if for people who've in the industry who followed us for years, we've got a lot of Twitter banter, a lot of Facebook banter. We love competing with each other, but also a lot of love and respect between the two of us.
Okay, I'm telling you, if I see a headline like 2 days from now that says Mediaocean buys Centro for $1 billion, I'm going to be pissed because I could have gotten the break from you now, but you're saying not going to happen. It'll start as a partnership first.
Well, listen, if there's a headline that says Mediaocean is buying us for $1 billion, I won't be pissed.
Robert, Bill, Brian.
I wouldn't bet on it, though. I doubt that one's coming.
There you guys have it. All right, fun stuff. Number 3, what's your favorite online tool for building your company?
I have no good answers for you on this.
That's okay. We'll skip it.
Yeah. You know what? I don't know. I'm looking over here. What are all the things that I use?
That's okay.
I don't think there's anything specific. I mean, we've gone through so many different damn tools, like for so many years. If anything, it's, look, the thing that we run our business on is the BI platform. So Pentaho has been a great tool for us overall to help launch that. And then, I think what Microsoft's done right now with Power BI, making it easy for kind of the masses to actually build dashboards, profiles, it's been great.
Yep. Number 4, how many hours of sleep you get every night?
7.5.
And situation, married, single, kids?
Single.
Okay. Any kids?
Nope.
All right. And how old are you?
Oh, I'm not answering that question.
Oh, come on. I was just about to say young, handsome, single. You have the world at your fingertips.
I wish I was young. Yeah, no, I'll be 47 coming up.
Oh, wow. That's much higher, I would have guessed. That's great. All right. Take us home. What do you wish your 20-year-old self knew?
I think I wish my 20-year-old self would know. You see, this is why I want the questions beforehand.
I know. He pinged,
guys.
He pinged me. He goes, Nathan, send me the questions beforehand. I said, Sean, those things are a very boring interview. They're all going to be on the spot, on the fly. So if you can't think of anything, that's okay. But anything on the top of your head?
No, man. Like, I mean, it's like I've always had this belief just in life that if you want to be successful, it's going to take a lot of hard work and effort to put in. And I knew that I wasn't as smart as most people. So, I've been working my ass off. If anything, I'd say probably try to figure out a way to create some more of a balance, because I just haven't had any balance, and kind of life is passing me by. And I'd probably say, work is great and the success is awesome and everything goes with it's awesome. But take time, just don't give up on the personal life as you go through it all.
Yeah, Sean, I would say the glass is always greener on the other side. I've interviewed many people that are in marriages or have kids that you think are happy and actually they're miserable. And they go, I wish I just had a company where I was financially free and independent. And here you are building this great thing. So guys, there you have it. Centro.
Thank you.
Centro.net caught $100 million, north of $100 million in revenue last year, hoping to break, call it 150, 160 this year. They've smartly used capital and stock and equity and seller financing notes to do M&A. They raised $52 million today, cash flow positive. Expect them to announce, call it, a fairly large, we'll call it north of $100 million round of financing here in the next, call it, year or so, as they look to provide some liquidity to early founders, shareholders, and most importantly, employees. They got a team of 700 people right now building out the company and 1,700 customers. Sean, thanks for taking us to the top.
Yeah, I appreciate it. Thanks, Nathan.